Hi, welcome to our video. We are Executive-MBA student from IPMI International Business School batch September 2022. The purpose of this video of the group class for the book event for our corporate finance class with our beloved lecturer, Professor Sembel. The book that we choose is A Random Walk Down Wall Street.
So the three of us here will be portraying the investment analyst that is having good time in Bursa Efek Jakarta cafeteria. So here we have Mbak Yulia Yunus as a fundamental analyst and Mas Muhammad Rifki as the technical analyst and I myself Astrid as the random walk analyst. So please enjoy our group 3 video.
The champion.
Hey, I just buy nickel shares like Harum, Inco, and also Antam.
Oh, really?
Really?
Yeah, because since the news said in 1 or 2 years from now, there will be several EV battery factories in Indonesia,
Oh.
and the nickel related shares will be go to the moon soon.
Well, I prefer to buy blue chip stock instead. Have you checked those shares that you mentioned?
Yes, of course, because
Their financial performance is showing healthy performance.
yeah, because as a technical analyst, I observe that patterns such much as market data, stock price, and stock transaction volume from the technical analyst standpoint.
As a fundamental analyst, I think we should focus more to buy shares with low price compared to its market.
Interesting. As I am a random walk analyst, so I have a different point of view. Well, I want to listen more about those point of view on how you choose the shares. Maybe Pak Rifki, can we start with you because you're the most handsome in between us? Like, tell us more. How do you choose the shares, please?
Understanding the science of stock analysis is critical because it allows you to better understand how to the market moves, as well as various terms that are frequently used in the world of trading under specific condition. The first, moving average, which is used to calculate the average movement of a stock over a given time period. Second, moving average divergence, which is considered the most accurate indicator for those of you who want to trade stock in the medium term and semi-investing in strategy with a time frame ranging from 3 weeks or to 30 weeks. And the third, relative strength index, which compare the attractiveness of price increase to the attractiveness of a price decrease with a value range of 0 to 100. And the last, stochastic, which is the most accurate indicator for swing trading and short-term investment, but can also be used for medium to long-term investment. What about you, Bu Yulia?
Fundamental analysis, better but still not perfect. In beating the market, investors tend to rely on one or two strategies, fundamental or technical approach. The investor who use fundamental approach to earn money in the market believe in firm foundation theory. This theory argues that the price of an investment is anchored in something called intrinsic value, and that the price of an asset typically over or underestimate this value. This theory suggests that stocks' values are roughly 90% rational and 10% psychological. To calculate the correct intrinsic value of stock, fundamentalists must assess the following voice signal. First, earning growth rate. The most important part of the calculation revolves around the estimation of future growth rates of earning. Second, the expected dividend payout. The higher the dividend payout, the greater the value of the stock. Everything else equal. Third, degree of risk. Everyone prefers an investment with a lower risk of losing money over an investment with a higher risk of losing money even though the expected returns are the same. Fourth, future market interest rates. The higher the risk-free rate of return, the higher the return should be expected from any other investment. Following up the theory above, we come into rational part, where by companies with average expected earnings growth for 5 years above, and that never pay more than foundation of value and look for good stories of growth. However, the problem is that no one can reliably assess value. There are many factors so the firm foundation theory does not work reliably. This book author has more respect for fundamental approach, but he says that's also lacking. Not only the whole idea of several flaws, but the results are poor. He says that analysts who were asked to predict the price of stock within 5 years were very inaccurate. They shortened the period to 1 year and they were even less accurate. And it wasn't a question of industry. No industry turned out to be easy to predict.
I, as the random walk analyst, believe that even a blindfolded monkey throwing darts at stock listing could select a portfolio that would do just as well as one selected by the experts. Markets behave like a random walk. Therefore, the market cannot be predicted. A random walk is one in which future steps or directions cannot be predicted on the basis of past history. So, why choosing the random walk theory? I have two reasoning here. First one, against fundamental analysis. There are three potential flaws in the fundamental analysis. First, the information collected may be incorrect. Analysts may be unable to translate correct facts into accurate estimates of future earnings. Second, the security analyst's estimates of value may be faulty. It is virtually impossible to translate specific estimates of growth into a single estimate of intrinsic value. And third, even with correct information and value estimates, the stock you buy might still go down. Past movement or trend of stock price or market cannot be used to predict its future movement. Calculation of past earning growth are no help in predicting the future growth. So there's a joke story to depict this. A professor walking along the street with a graduate student, where the student spot a $100 bill lying on the ground, right? And then the student stoops to pick it up. So the professor said, "Don't bother to try to pick it up. If it was really a $100 bill, it wouldn't be there." So in other words, the story is telling you that if any $100 bills are lying around, there will be there not for long. Someone else will already grab it. So why choosing random walk theory? Number two, against the technical analysis. Technical analysis undependable because the technical analysis or chartists, users, they only buy or sell security after an established trend has developed. Note that chartists buy only after price trends has been established and sells only after they have been broken. Because sharp reversal in market may occur quite suddenly, the chartist often misses the boat. By the time an uptrend is signaled, it may already have taken place. So such techniques must ultimately to be self-defeating. As more and more people use it, the value of any technical analysis will depreciate. So what is the recommendation then? The recommendation from the random walk theory is investors would be far better off buying and holding an index fund than attempting to buy and sell individual securities or actively manage mutual funds. Buying and holding all the stocks in a broad stock market average was likely to outperform professionally managed funds, whose high expense charges and large trading costs detract substantially from investment returns. Stock investors can do no better than simply buying and holding an index fund that owns a portfolio consisting of all the stocks in the market.
Okay, to summarize our discussion today about this book, then I can start from myself. Random Walk Down Wall Street explores how the individual investor can make money in the stock market by following a simple path that is guaranteed to bring success if the investor has patience and gets accustomed to a series of concepts about stock and what analyzing them consists of. Do you have any thought as your summary, Bu Astrid?
So here's 3 summary from the book. Number 1, the market moves randomly and unpredictably. Number 2, don't try to outperform the market. Number 3, better to keep all range of stocks or choose the index fund.
Here are my 3 favorite lessons from the book. First, a healthy dose of risk can be good for your portfolio. Second, you cannot beat the market. Third, learn to control the psychological factor of investing.
Finally, we have come to the end of our video. Have a great day.
Bye!